Cryptocurrency once emerged as the dazzling frontier of finance, promising to revolutionize how money flows across the globe. Its rise was meteoric, capturing the imagination of investors, technologists, and everyday people alike. Yet today, the market finds itself navigating turbulent waters, marked by a notable decline. To truly understand why cryptocurrency is waning at this moment, we must embark on a journey through a complex web of economic forces, regulatory challenges, and psychological shifts. At its core, the decline in cryptocurrency is not the result of a single event but rather a compound of interrelated factors, each feeding into the other. One of the most significant contributors is the tightening of global regulatory frameworks. Governments worldwide, once hesitant and slow to respond, have now begun to impose stringent regulations on digital assets. For example, increased scrutiny from financial watchdogs and tax authorities discourages speculative trading and complicates the accessibility of certain crypto products. Regulatory uncertainty creates an environment where large-scale institutional investment is less willing to deploy vast sums, causing a pullback in market liquidity and confidence. Moving beyond the regulatory landscape, macroeconomic factors exert tremendous influence. Inflationary pressures, rising interest rates, and global economic instability have shifted investor appetites towards safer, more traditional assets. Cryptocurrencies, often viewed as high-risk, speculative investments, find themselves less appealing against this backdrop of tightening monetary policy and economic caution. As central banks raise interest rates to combat inflation, the opportunity cost of holding non-yielding assets like Bitcoin or Ethereum escalates, further pressuring crypto valuations downward. On the technological and market sentiment front, the sector grapples with eroding public trust and unresolved challenges. High-profile hacks, fraudulent schemes, and the fallout from failed stablecoins have chipped away at the image of cryptocurrency as a secure alternative to conventional currencies. Moreover, the sector's intrinsic volatility, once a thrilling attribute for speculative investors, has become a deterrent for more risk-averse participants. The psychological wave that propelled crypto prices upward now partly reverses, as fear and uncertainty trigger sell-offs and cautious market behavior. However, the decline is not an outright condemnation of cryptocurrency's future. Instead, it reflects a painful maturation process, a market recalibrating from euphoria to realism. The current downturn pressures the industry to innovate responsibly, strengthen its foundations, and build trust that transcends hype. While prices fall, advancements in underlying blockchain technology, regulatory compliance, and mainstream adoption continue to unfold patiently in the background. In conclusion, the decline in cryptocurrency today is a convergence of tightening regulations, macroeconomic headwinds, and shaken market confidence. Yet amid this turbulence lies the potential for a more robust, sustainable financial ecosystem built upon lessons hard-earned through hardship. This moment is not just a setback but a pivotal chapter in the evolving narrative of digital currency, one where caution tempers exuberance and resilience carves the path forward.